Hi, it's Kenneth Donovan, licensed real estate agent with Miranda Realty Group in upstate New York. So before we dive into the purchase agreements, I wanted to go over different types of loans and different terminology you should know. So different types of loans. First, you got a conventional loan, which is usually backed by private lenders. So those loans, they consist of a down payment of 20% or greater, but the bright side is you don't have that private mortgage insurance. But if you do have less than the 20% down payment, then the lenders are going to want you to pay that private mortgage insurance, so they have that guarantee they're not going to lose out on their loan. Also, you need a decent credit score, 620. If you have a better one, that's better. You get better interest rates. So that's a conventional loan. Then you got a FHA loan. That's the Federal Housing Administration loan. That loan, you want a credit score of 620, although they do go lower. It's usually first-time home buyers go-to loan. That one requires a big difference in down payment. On the bright side, it's less. It's 3.5%. It could go as low as 3.5%. But you need to pay for mortgage insurance premium, and there's going to be an upfront one, and there's going to be an annual one you have to pay. So that's a FHA loan. Then you got a VA loan that's backed by the Department of Veteran Affairs. That loan goes for people who served and even their spouses. So that loan consists of no down payment, so that's great. That one got no down payment. Credit score, they generally want a decent credit score, 620, but they're flexible with that one. A good underwriter could get it to, I don't know, maybe 580, I would say. Don't quote me though, but that loan is good. And on the bright side too, there's only a one upfront fee, and that usually gets waived if you're a disabled veteran. So most disabled veterans get that exempt and they don't have to pay that. And last, you got a USDA loan. That's the United States Department of Agriculture loan. That loan consists of no down payment, so 0% upfront cost. And that loan, you have to have a decent credit score. We're talking probably 620, better to have it 640, because then you have that automated underwriting. But 620, and they may go lower depending on several financial factors. And that loan has, kind of like the FHA, they have fees. You have the upfront fee, and then you have the annual fees. But like I said before, there's zero upfront cost. So that's it for loans. If you have any questions, comments, or concerns, please comment them below. And please follow, like, and subscribe, and make sure you stay tuned for next video. Thank you.